Welcome back to Investing Talk Podcast. Today we're going to be looking at DraftKings,
Okay.
ticker symbol DKNG.
Yeah.
And there's a lot to unpack here.
Yeah.
We've
Yeah.
got strong revenue growth, even in what was kind of a challenging year. For the market overall,
Right.
analysts are projecting
Yeah.
some pretty serious gains when it comes to share price. They had a really interesting acquisition,
Interesting.
and they've got this new customer surcharge plan. That could really shake things up.
Okay.
So to kind of kick things off, can you tell us a bit about DraftKings' recent performance?
Well, they've posted a 26%
Yeah,
year-over-year revenue increase, reaching $1.104 billion last quarter.
that sounds really impressive.
It is,
Yeah.
especially given the context of the broader market. However, they did slightly miss analysts' revenue expectations, which were closer to $1.12 billion. And their adjusted EBITDA also came in below projections.
So it's kind of a mixed bag then, like impressive growth, but still falling a little bit short expectations.
Exactly. It is kind of a puzzle
Yeah.
because while they missed these short-term targets, the long-term projections are incredibly optimistic. Analysts predict that revenue will surge $5.89 billion by 2025. That's a compound annual growth rate of over 26%.
Wow. That is a significant jump. So what about profitability? You mentioned EBITDA earlier. Any positive news there?
Absolutely. They're projecting to swing to a positive EBITDA of $987.10 million in 2025. This is a really dramatic turnaround from the losses they've experienced this year.
So for our listeners who are trying to make sense of this contrast, right? Slight misses the recent quarter, but these really positive long-term projections, what do you make of it?
It's a great question. You know to me. It speaks to both resilience and potential areas for further analysis. The fact that DraftKings is still attracting new customers and expanding their operations, even in a challenging environment, I think that's a very positive sign. At the same time, those missed expectations highlight the importance of really digging into those underlying factors that are driving their performance.
Okay, so let's talk about the bigger market context here. Is DraftKings fighting an uphill battle, or are they riding a wave of positive market trends?
Well, the projections for the broader market in 2025 are generally positive. Analysts predict gains across major indices, like the Nasdaq and the S&P 500. And this rising tide tends to lift most boats, including stocks like DraftKings, if we look specifically at analyst sentiment. For DraftKings, it's overwhelmingly bullish. Price targets for 2025 are averaging around $89.36, a potential upside of 136% from the current price of $37.20.
136%. It's huge, but sometimes technical analysis can tell a different story. What are the charts saying?
Good point. Technical analysis can add another layer to our understanding. In the case of DraftKings, it's a bit of a mixed bag. Some indicators, like the 50-day and 200-day moving averages, suggest a hold recommendation. For now, however, the long-term trends are definitely pointing upwards.
Can you unpack those technical indicators
Yeah.
for our listeners who might not be as familiar with them? What story are the moving averages
Yeah.
and RSI telling us about DraftKings?
Sure. The fact that the stock price is currently below both its 50-day and 200-day moving averages suggests some short-term bearishness or downward pressure. However, the relative strength index, or RSI, is hovering near what's considered oversold territory, which hints at a potential bounce back in the near future.
Okay, so short-term caution, but long-term potential. It sounds like DraftKings is playing the long game. But how are they positioning themselves for this future growth? What strategic moves are they making?
Well, one of the biggest drivers for DraftKings is the ongoing legalization of sports betting and online gaming. Across the U.S., it's a massive tailwind for the entire industry. And DraftKings is well positioned to capitalize on this trend. They're currently operating in 25 states, plus Washington, D.C., covering nearly half the U.S. population.
It seems like every week another state is legalizing some form of online gaming. It's definitely a growing market.
Exactly. And DraftKings isn't just passively riding this wave. They are actively working to expand their user base. Their customer acquisition strategy seems to be working quite well, as they've seen an 80% increase in new online sports betting customers year over year.
80%. That's incredible. So they're playing in a rapidly expanding market and doing a great job of attracting new users. What else are they doing to solidify their position.
You're making some strategic moves
Yeah.
to capitalize on this growth. One of the most interesting developments is their recent acquisition of Jackpocket.
Jackpocket, what do they do? And how does this acquisition fit into DraftKings' overall strategy?
Jackpocket is a mobile lottery app, and this acquisition is all about expanding DraftKings' customer base, especially in the rapidly growing online lottery market.
So it's a diversification play, tapping into a new revenue stream.
Exactly. They're not putting all their eggs in one basket. And that's a smart move in a dynamic industry like online gaming.
Absolutely. Expanding into new markets
Right.
and diversifying their offerings can certainly help them mitigate risk and capitalize on emerging trends. And it sounds like they're not stopping there. They have this new plan to implement a surcharge on winnings
Right.
for customers in high-tax states starting January 1st, 2025. What's the rationale behind that?
It's projected to significantly boost their EBITDA
Hmm.
in 2025, essentially. They're passing on some of the tax burden to
Yeah.
customers in certain states, which could improve their profitability.
That's a bold move. But it could also be controversial. How do you think this surcharge will be received by customers and investors?
It's hard to say for sure. It'll be interesting to see how this plays out in terms of customer retention and investor confidence. But it definitely highlights DraftKings' focus on driving profitability, even if it means making tough decisions.
It certainly adds another layer of complexity to their story. So far, we've talked a lot about growth and expansion, but not all of their moves have been about pushing forward. They recently announced the closure of their live dealer casino studio in Atlantic City and planned layoffs of 101 employees.
That's right. This could signal a shift in strategy or simply a cost-cutting measure. It's important for investors to consider how this decision aligns, or perhaps doesn't align, with the company's overall growth narrative.
It's a move that seems to contradict their ambitious expansion plans. Perhaps they're simply optimizing their operations and focusing resources on areas with higher growth potential.
That's a possibility. It'll be interesting to see how they explain this decision and how it fits into their long-term plans.
Okay, so we've covered a lot of ground here. DraftKings is clearly a company in motion, making big bets on the future of online gaming, while also facing some challenges and making tough decisions along the way. We'll continue to follow their progress closely. For our listeners, what are some key takeaways you'd highlight from this part of our discussion?
I think the main takeaway to the DraftKings is operating in a rapidly evolving and highly competitive market. Their strong revenue growth and bold moves demonstrate ambition, but they also face challenges. It's crucial to look beyond the headlines and understand the underlying factors driving their performance, both positive and negative.
Great advice. Always look beyond the headlines. Now I'll take a quick break. When we come back, we'll continue our discussion on DraftKings, exploring more about their financials, their competitive landscape, and what the future might hold. Stay tuned. Welcome back to Investing Talk Podcast. Before the break, we were talking about DraftKings' impressive growth and their strategic moves to capitalize on that expanding online gaming market. We also touched on some of the challenges they face, like slightly missing earnings, expectations in that decision. To close their Atlantic City studio, it seems like they're walking a tightrope between, ambitious expansion and this need to manage costs effectively.
That's a great observation, and it's a theme you'll see play out in a lot of growth companies. They need to invest heavily to fuel that growth, but they also need to keep an eye on the bottom line and demonstrate a clear path to profitability.
So let's dig a little deeper into DraftKings financials. What are some key metrics our listeners should be paying attention to beyond the revenue and EBITDA we've already talked about?
Well, it's important to look at metrics that give you some insight into the efficiency and the sustainability of their growth. So keep an eye on things like customer acquisition cost, average revenue per user, and churn rate.
Okay, break those down for us. Why are those metrics so important when evaluating a company like DraftKings?
Sure. So customer acquisition cost, or CAC, tells you how much DraftKings is spending to acquire each new customer. Ideally, you want to see that number trending downwards over time, indicating that they're becoming more efficient at attracting users, and their marketing efforts are becoming more effective.
Makes sense. Spending less to acquire each customer means higher profitability in the long run.
Exactly. Now, average revenue per user, or ARPU, is a measure of how much revenue DraftKings generates from each customer. On average, a rising ARPU suggests they're doing a good job of monetizing their user base, perhaps through cross-selling or offering higher value services.
And churn rate, that tells us about customer retention, right?
Precisely. Churn rate measures the percentage of customers who stop using DraftKings services over a given period. A high churn rate can be a red flag indicating problems with customer satisfaction, or increased competition, you want to see a low, and stable churn rate, as this means customers are sticking around and continuing to generate revenue for the company.
So for our listeners
Sure.
who are considering adding DraftKings to their portfolio, what should they be watching for in terms of these metrics? What would be considered a positive or negative sign?
I'd say keep a close eye on all three metrics. If DraftKings can continue to lower their CAC, increase their ARPU, and maintain a healthy churn rate, it bodes very well for their long-term profitability and suggests they have a sustainable business model.
Okay, so financials are crucial, no doubt. But let's not forget about the competitive landscape. DraftKings isn't playing in a vacuum. Who are their main rivals, and how are they differentiating themselves in such a crowded market?
Yeah, the online gaming market is incredibly competitive, with several major players vying for market share. DraftKings' main rivals include companies like FanDuel, BetMGM, and Caesars Entertainment, all of which have significant resources and brand recognition.
So how is DraftKings setting themselves apart in this crowded field? What are they doing to attract and retain customers?
Well, they're focusing on a few key things. First, they're leveraging their strong brand recognition and marketing expertise to attract new users. You see their ads everywhere, from TV commercials to social media campaigns.
Certainly have strong brand presence.
They do, and it's a valuable asset in this market.
Yeah.
Second, they're offering a wide range of betting options and fantasy sports contests to appeal to a broad audience. They want to be a one-stop shop for all things online gaming.
And third,
They're investing heavily in technology and innovation to improve the user experience and create engaging new features. They want their platform to be the most user-friendly and enjoyable to use.
but I'm curious, how much does brand loyalty really matter in this space? Are users sticking with one platform, or are they shopping around for the best odds and promotions?
That's a great question, and it's something that DraftKings is keenly aware of. While brand loyalty does play a role, it's not as strong as it might be in other industries. Many users are indeed price sensitive and willing to switch platforms if they find better odds or more generous bonuses elsewhere.
So for DraftKings to win in the long run, they need to be more than just a familiar name. They need to consistently offer compelling value and a superior user experience to keep customers coming back.
Absolutely. It's a race to the top in terms of both innovation and customer satisfaction. And that's why their investments in technology and
Right.
data analytics are so crucial. They need to personalize the experience, anticipate user needs, and offer the right promotions at the right time to stay ahead of the competition.
It sounds like DraftKings is playing a multidimensional chess game here, trying to stay ahead of the competition while also navigating a complex regulatory environment as online gaming laws continue to evolve.
It's definitely a challenging, but also incredibly exciting space to watch. The online gaming industry is still in its early stages, and there's a lot of potential for growth and disruption. Companies like DraftKings that can adapt quickly and innovate will be the ones that thrive in this dynamic market.
Speaking of disruption, we talked earlier about DraftKings' acquisition of Jackpocket and their plans to implement a winning surcharge. Those are pretty bold moves. What other potential disruptors or game changers should we be keeping an eye on in this industry?
Well, one area to watch is the convergence of online gaming with other forms of entertainment like esports and social media. We could see more integration between these different worlds, creating new opportunities for companies like DraftKings.
Interesting. So we might see DraftKings branching out beyond traditional sports betting and fantasy sports, offering a diversified entertainment experience.
It's certainly possible they could partner with esports leagues, offer in-game betting options, or even create their own social gaming platforms where users can interact and compete with each other.
That would be a significant shift, expanding their reach and tapping into new audiences. And what about technological advancements? Are there any emerging technologies that could shake things up in the online gaming world?
Definitely. Technologies like virtual reality, augmented reality, and blockchain technology have the potential to transform the user experience and create entirely new ways to engage with online gaming. Imagine being able to immerse yourself in a virtual casino or attend a live sporting event from the comfort of your own home using VR or using blockchain to ensure fair and transparent gaming outcomes.
That sounds incredibly futuristic, but it's not hard to imagine those technologies becoming mainstream in the near future.
Exactly. And the companies that are willing to experiment and push boundaries
Yeah.
with these new technologies are the ones most likely to succeed. In this rapidly evolving industry, DraftKings has a history of innovation, so it wouldn't be surprising to see them at the forefront of these advancements.
So our listeners should be watching for signals that DraftKings is embracing these new technologies and exploring innovative ways to leverage them, to enhance their platform.
And attract new users.
Absolutely. The companies that can anticipate and adapt to these technological shifts will be the ones that define the future of online gaming.
Okay, we've talked about DraftKings financials, their competitive landscape, and some potential disruptors on the horizon. But let's bring it back to our listener, who's maybe trying to decide whether to invest in DraftKings. What are some key considerations they should keep in mind before making a decision?
First and foremost, they need to assess their own risk tolerance. DraftKings is a growth stock, which means it comes with higher volatility and potential for both big gains and big losses. It's not a suitable investment for everyone, particularly those who are risk-averse or have a short-term investment horizon.
So not for the faint of heart. It's important to understand that the stock price can fluctuate significantly, and investors need to be comfortable with those ups and downs. Exactly. Growth stocks are inherently more volatile than more established companies. Investors need to be prepared for a bumpy ride and have a long-term perspective if you're looking for a stable and predictable investment. DraftKings might not be the right fit for you.
What else should potential investors be thinking about when evaluating DraftKings?
They need to do their due diligence. That means researching DraftKings' business model, their management team, their financial performance, and their competitive landscape. Don't just jump on the bandwagon because everyone's talking about them. Take the time to understand their business, their strengths, and their weaknesses.
So it's about making an informed decision based on solid research,
Yeah.
not just following the hype.
Precisely. Investors need to understand the risks and potential rewards before putting their money on the line. There's a lot of information available about DraftKings, from their financial reports to industry analyses to news articles. It's important to gather as much information as possible and form your own independent opinion.
And finally, investors need to have a clear investment thesis. What do they believe about DraftKings and future prospects, and how does that fit in to their overall investment strategy?
Right. It's not enough to simply think DraftKings is a cool company or that they're going to make a lot of money. Investors need to articulate why they believe DraftKings will succeed, what differentiates them from the competition, and how that success will translate into financial returns for them as shareholders.
So it's about having a well-defined rationale for investing, a clear understanding of why this particular company aligns with your investment goals
Yeah.
and risk tolerance.
Exactly. Investing should never be based on gut feeling or speculation. It's about making calculated decisions based on research, analysis, and a well-defined investment strategy. If you can articulate why you believe in DraftKings and how it fits into your overall portfolio, you're in a much better position to make an informed decision.
So a lot to consider, but for those who do their homework and believe in DraftKings, long-term potential, it could be an exciting and potentially profitable investment.
Indeed. The online gaming industry is poised for significant growth, and DraftKings is well-positioned to capitalize on that trend. But as with any investment, it's crucial to proceed with caution, make informed decisions, and manage your risk accordingly.
Excellent advice. Now we're going to move on to our final segment. We'll wrap up our discussion of DraftKings with some final thoughts and key takeaways for our listeners. Welcome back to Investing Talk Podcast. We've spent this episode exploring the world of DraftKings, ticker symbol DKNG, looking at their recent performance, their strategic decisions, and what the future might hold for this major player. In the online gaming world, we've covered a lot of ground, from impressive revenue growth to strategic acquisitions like their purchase of Jackpocket, to a new customer surcharge plan that has certainly sparked debate. So as we wrap things up, let's bring it all together. What are some of the key takeaways for our listeners who may be considering adding DraftKings to their portfolio?
Well, I think the main takeaway here is that DraftKings
Is a company operating
at the intersection
of tremendous opportunity
Yeah.
and significant challenges. They've demonstrated impressive growth and ambition, but they're also facing stiff competition. In a rapidly evolving market, their success will depend on their ability to continue attracting new users, increasing the revenue they generate from each user, and effectively managing costs, all while navigating a complex and constantly changing regulatory landscape as more states legalize various forms of online gaming.
It sounds like a delicate balancing act. They need to keep that growth engine humming while also proving to investors that they can achieve.
Sustainable profitability.
Exactly. And that's where those key metrics we discussed earlier really come into play. Customer acquisition cost, average revenue per user, and churn rate. Investors should closely monitor these metrics to see if DraftKings can continue to lower their customer acquisition costs, increase their average revenue per user, and keep their churn rate low, indicating strong customer retention.
They also need to stay ahead of the curve. In terms of innovation and technology, the online gaming world is constantly evolving, with new technologies and trends emerging all the time.
Absolutely. DraftKings needs to remain agile and forward-thinking to maintain its leadership position. That means embracing new technologies, exploring new partnerships, and perhaps even venturing into new markets and expanding beyond their current offerings.
So a lot to watch for. One thing is for sure, DraftKings isn't afraid to make bold moves, and that makes them a fascinating company to follow, whether you're an investor or simply someone interested in the future of online gaming.
I agree. It's a dynamic and exciting industry to track. But as with any investment, it's crucial to do your research, assess your personal risk tolerance, and develop a clear investment thesis before making any decisions.
To our listeners, we've given you a lot to think about today. Regarding DraftKings, we encourage you to continue your own research using the ticker symbol DKNG and come to your own conclusions. Here's a final thought-provoking question to leave you with. Given everything we've discussed, do you think DraftKings is poised for a breakout year in 2025? That's all for this episode of Investing Talk Podcast. Thanks for listening. If you enjoyed this episode, please consider subscribing to our channel, sharing it with your friends, and leaving us a comment below. Until next time, happy investing.